Hello, I'm Josh Finkelstein, and this is my social studies project, the 1920s project, and we're going to be discussing the 1929 stock market crash. And to explain this subject with me is, you can introduce yourself.
Thank you. My name is Mark Sachs. I'm a Senior Managing Director with R.J. O'Brien and Associates here in Chicago. While our primary focus is in commodity futures, I also hold licenses to transact securities in either stocks or bonds. In order to do so, you're required to pass examinations, which I have, namely the Series 7, which is the basic requirement, and also the Series 24 examination, which is required for those who have supervisory responsibilities over those who deal in securities as well.
Okay, so what caused the 1929 stock market crash?
Well, the 1920s was an era of tremendous prosperity. And during that time, there was the proliferation of the automobile, telephone, electricity, many other different things that went on during that period, which led to a great economic boom. Along with that economic boom came a boom in the stock market as well. In fact, it increased tenfold over a period of several years during the 20s, to a point where people thought that it was the easiest and quickest way to get rich. One of the main reasons for the crash, if not the main reason, was the fact that people could buy stocks with putting down very little money, known as margin. As an example, if you wanted to buy a stock that cost $100 at $10 a share, you would think you had to put up $1,000 to buy that share of stock. The reality was that you only had to put up 10%, and the brokerage firm would loan you the other 90%, which introduced tremendous amounts of leverage. So, and as an example, to buy that stock, that 100 shares of stock at $10, which would be worth $1,000, you were only required to put up $100 with your brokerage firm. That allowed for a lot of speculation in the market as people were able to accumulate more and more shares. That effect alone drove prices to stratospheric levels. In fact, I believe that the stock market reached a high, the Dow Jones Industrial Average, of 381 in late October of 1929. Towards the end, as the market had sort of reached its plateau, as they always do, it started to turn south. And I think on Thursday, before it was known as Black Monday or Black Tuesday, the market alone lost 11%. As that happened, people were being called for margins on the accounts that they had, meaning that if they had that that 10% margin up, meaning that they only had $100 up, if the stock that they owned fell 10%, they had basically lost all of the money that they had put up, and the brokerage firm was forced to either require more money out of the client to maintain the position or liquidate the position. That required clients to do a lot of selling as they couldn't meet the margin calls. And as more selling came in, that applied more downward pressure on the market. And selling begat selling until the market continued south for quite a bit of time. In fact, it continued south and didn't reach its low until sometime in 1932, where the market at that point had lost 89% of its value, and people's fortunes were largely wiped out.
Okay, what was the general attitude in 1929 about the stock market?
People thought that stocks were the easiest way to get rich, and because you could buy on such low margin levels, it became a mania. Everyone wanted to buy, it was easy to buy, and that's what drove prices higher more than anything.
Okay, what caused the market to crash?
Well, again, it was the fact that there was so much leverage in the market that people had bought shares using such little money down that when there were no buyers left, it became an unsustainable level. And that once the market reaches a certain plateau and there's no more buyers left, the markets generally tend to head south. And that's when leverage starts to work against you.
Okay, how long did the crash last?
Well, the crash itself, again, lasted for a few years. It didn't bottom out until some point in 1932, and many stocks were wiped out entirely. Some of the more Stable companies, survived, and some even continue to survive to this day, I believe, such as General Electric. But it lost 89% of its value by 1932 when we entered what is known as the Great Depression.
Okay. What was the immediate effect of the crash?
The immediate effect of the crash was that people who had bought so much stock on margin didn't have any more money to meet their margin calls, and therefore the brokers had to sell out their positions, and people were left with no money whatsoever. It also caused problems for banks, because banks were the ones that were lending money to the brokerage firms to lend money to the clients to buy money on margin. As an effect of that, a lot of banks went out of business. They couldn't pay back their depositors, and what's known as a run on the bank. As people heard that people were taking their deposits out of the bank, more people started to run to the banks and demand their money, until the banks said, we have no more money. It's been lent out either to homeowners or farmland owners or to brokerage firms who were lending money to securities firms to provide margin to their clients.
What did the government do to prevent a similar crash?
Well, the government did a few things. The first things that what they did was they created the Securities Act of 1933, which basically required the companies issuing new stock to issue accurate financial statements of a firm which was going public. Now, going public means a privately held firm that wants to raise money, maybe perhaps to do new projects that they want to do, new capital investment. So they go out and they issue stock in their company to the public. So the Securities Act of 1933 required that any company that wanted to go public to require more accurate financial statements, and it also was an attempt to crack down on manipulation of the market as well, and wrongdoings by individuals.
Okay. Did this prevent other crashes?
Well, there was another even more important act passed the following year called the Securities Exchange Act of 1934. What that did was that created the Securities and Exchange Commission, which exists to this day. The Securities and Exchange Commission is charged with regulating all aspects of the financial services industry. So they're responsible for making sure that all brokers are licensed, that all exchanges operate properly, that all companies that report financial statements quarterly provide accurate financial statements. They're also authorized to bring civil and even criminal actions against individuals who try and manipulate the market by spreading false information. Another way that they crack down is to prevent what's known as insider information. So some individuals had knowledge about companies, whether they were going to come out with better earnings reports before the public did, and if they knew that a company was going to report better earnings, they could buy the stock early. When the company released its earnings reports, the markets would go higher, and then they could sell out before anybody else did and make a profit. Similarly, if they knew that a company was going to come out with poorer earning results, they could actually sell short the market, bet on the market going down, and then when the earnings reports came out and they weren't as favorable as expected, that particular stock would go down, and the person with insider information could then buy back the stock at a lower price, profiting that way as well. So the Securities and Exchange Commission has broad powers to regulate the entire industry. And one of the most important things that they did was that they changed the margin rules. They realized that allowing individuals to buy stocks with only 10% down introduced too much leverage into the marketplace. So they came up with what's now known as Regulation T. Regulation T allows the Federal Reserve Board to set the minimum margin that an individual must put down in order to buy a stock. So today it's 50%. So using that prior example, if you wanted to buy 100 shares of a stock that's trading at $10, that's $1,000. Before Regulation T came along, again, you only had to put down $100 or 10%. Today, if you want to buy a stock on margin, you have to put up 50% of the purchase price of that stock at a minimum. So you'd have to put down $500. So that reduced the ability for people to leverage the positions in the marketplace. Now, just because you can buy stocks with only 50% down doesn't mean that you have to. In fact, most people, including myself, when I buy a stock, I like to pay the full value. So if I buy a share of